All right, welcome. Today we are diving into a really cool puzzle, one that honestly seems kind of impossible at first. We're going to figure out how to lock in a profit that's completely 100% risk-free. It's a mix of market dynamics, a little bit of probability, and a really clever strategy. Let's see if we can solve this thing together. So, this is the big question, isn't it? It sounds like a trick question, like a riddle. I mean, how could you possibly set things up so you win no matter what happens? It just doesn't sound real. Well, here's the thing. The answer is, surprisingly, yes. And we're about to break down exactly how that works. To solve any good puzzle, you need clues. And for this one, our two big clues are these concepts right here: arbitrage and prediction markets. If you can get your head around these two ideas, you've basically got the key that unlocks the entire thing. First up, let's talk about arbitrage. Now, don't let the fancy word throw you off. The idea is actually super simple. Imagine one store is selling a collector's coin for $9. And literally right next door, another store is buying that exact same coin for 11 bucks. Well, if you could buy it from the first place and immediately sell it to the second, you've just made $2, risk-free. That right there, that's arbitrage. Okay, our second clue is the prediction market. Think of it like a stock market, but for events. Instead of buying a piece of a company, you're buying yes or no shares on whether something is going to happen. And here's the crucial part: the price tells you something. If a yes share costs, say, 70 cents, that means the market thinks there's about a 70% chance of that event happening. And if you're right, your share pays out a full dollar. So we have our clues, we know the concepts, now we need the right tools for the job. And for what we're doing today, we're going to be looking at two specific platforms: Polymarket and Kalshi. Think of these as the two shops from our coin example. These are the places where these opportunities are going to pop up. Now, what makes these two platforms so perfect for our puzzle is that they're pretty different from each other. See, Polymarket is all about crypto, while Kalshi is regulated in the US and uses regular dollars. They focus on slightly different things and attract different kinds of traders. And because of that, sometimes, just for a moment, they can disagree on the odds of the very same event. And that little disagreement, that's our window. That's where the magic happens. All right, we've got the clues, we've got the tools. It is time to put it all together. Let's walk through step by step how to solve this puzzle and actually execute the play that locks in a guaranteed profit. And you know what? The process itself is surprisingly simple. It's really just a 4-step loop. First, you gotta hunt down those conflicting prices on the same event. Second, you do a quick bit of math to make sure the opportunity is real. Third, you figure out how many shares to buy. And last, you pull the trigger and place your trades on both platforms. And here it is. This is the secret. This is the simple rule of thumb that tells you there's a risk-free profit on the table. A winning contract always pays out $1, right? So the opportunity exists when the total cost to buy a yes share on one market and a no share on the other market is less than $1. That little gap between your cost and that $1 payout, that's your guaranteed profit. Okay, let's look at a real-world example to make this concrete. Imagine you're scanning the markets, and on Polymarket, the yes shares for an event cost 65 cents. But at the exact same time, over on Kalshi, the no shares for that same event are trading for 45 cents. Boom! You've just spotted conflicting odds. Okay, but hold on. Let's run this through our rule. A yes for 65 cents plus a no for 45 cents, that adds up to a total cost of $1.10. But remember, the max payout is only ever $1. So this is a trap. If you take this trade, you are guaranteed to lose 10 cents on every pair of shares. This is a perfect example of why you have to check the math. For this to work, our total cost has to be under $1. So let's see what that looks like. Okay, now this is a winning scenario. Let's say you find yes shares for 60 cents on one market and the no shares for just 35 cents on the other. Let's do the math. Your total cost to cover both outcomes is now just 95 cents. So think about it. It doesn't matter what happens. Whether yes wins or no wins, you're guaranteed to get paid $1. You spent 95 cents to guarantee a $1 return. And that difference, that 5 cents, is your guaranteed, locked-in, totally risk-free profit. Now, you scale that up, buy 100 of each, and you've just made $5, no matter the outcome. And just like that, puzzle solved. Of course, knowing the solution to a puzzle in theory is one thing. Actually pulling it off in the real world, that's a whole other ballgame. So let's open up the master's notebook and look at some pro strategies and, just as important, the hidden dangers you gotta watch out for. So to do this effectively, it's all about speed. The pros use bots and alerts because these little price gaps can disappear in seconds. You also have to stick to popular markets, ones with lots of trading, so you can actually buy enough shares to make it worth your while. And you have to, always factor in the fees because they can easily turn a small profit into a loss. But listen, this is not a magic money machine, and it's so important to understand the risks. The biggest one is that the price might change right after you buy that first share, but before you can buy the second one. Or you might not find enough people willing to sell you the shares you need. And remember, your money is tied up, it's locked in, until that event actually resolves. That could be days, weeks, or even longer. So what's the big takeaway here? Arbitrage isn't really a glitch or some magic trick. In a way, people who do this are like market mechanics. They find these tiny, temporary pricing mistakes, and by making these trades, they actually help push the prices back in line, making the market more efficient for everybody else. It's like a reward for being sharp-eyed. And all of that leaves us with one final big question to chew on. Now that you know how this works, do you think arbitrage is a feature or a bug? Are the people who do this essential players keeping the market honest? Or are they just exploiting flaws in the system? Something to think about. Thanks for tuning in.